Hello, everybody. So today is a response to the All-In podcast and the few sentences that were discussed about MicroStrategy in the All-In podcast. I admire the All-In podcast. I think the PayPal Mafia was wonderful, and I invest heavily in a stock like Tesla. So this is not a criticism in any way. In many ways, it's a praise of the All-In podcast. I want to begin this video by the conclusion of this video before I go to my response. The conclusion of this video is volatility is vitality. And please stay with me a second. An oil refinery, let's take an example. Let's take Chevron's example, the example of a refinery. You refine oil. You can charge a premium for high octane fuel that is highly unstable, fuel that you don't want to throw on the barbecue. Don't ever make that mistake. There is fuel that makes your engine go faster. In the US, we may be used to seeing 87, 89, 91 octane. 87 octane is regular. That's the cheapest fuel. And if you buy, say, a German car, oftentimes they'll tell you need to use an 89 or 91 octane. And sometimes in the US, you see racing cars maybe out of place. Maybe it's a Texas thing, I don't know. But you'll see racing fuels on some gas station, gas pumps, but you can see racing fuel is $7.99 because it's 100 octane. Regular fuel is $4.69 a gallon because it's 87 octane. Chevron is able to charge much more for racing fuel than it is for regular fuel. And as a result of that, I believe it makes sense for these fuel companies to make racing fuel because the premium is higher on racing fuel, and that's what you want to sell. And this is the story of MicroStrategy. MicroStrategy is a Bitcoin treasury company. Part of what they do is issue debt, issue convertible debt. That is half of their 2121 plan, the 42 billion raise that they've announced. Half of that plan is about issuing convertible bonds. And do you want to issue a low octane convertible bond, one that's rated at 87? Or do you want to issue a high-octane convertible bond, one that's rated at 100? And MicroStrategy is late issuing its convertible bond. In fact, it's mostly done in ATM so far. Why is it so late for issuing the convertible bonds? It's so late because it wants to sell highly volatile bonds. He wants to sell a convertible bond, a convertible debt on a highly volatile stock. MicroStrategy wants to be a stock that outperforms the market, that outperforms Bitcoin, but in a very volatile way, up, down, up, down, up, down. Why? Because if you sell an instrument on a very volatile stock, you can charge a much higher premium in that instrument. And the point I'm making in that video is that that premium may take the form of negative interest rate, negative coupons in the future if the volatility keeps going for MicroStrategy. And you don't want to sell convertible debt on a low volatility stock. A low vol stock is not going to get you as high of a premium and as much oversubscription to your bond. If you have low volatility, high volatility is going to get you high subscription to the bond and a high premium. Just like Chevron, they're going to be able to charge more for the racing fuel because the racing fuel makes your engine go faster. The highly volatile convertible debt of MicroStrategy makes the gamma trade of hedge funds much, quote-unquote, faster, much more profitable. You can be much more profitable on gamma by selling highly volatile, high-octane convertible debt than you can on low octane, low volatility convertible debt. And so this is part of a MicroStrategy playbook. He's trying to make the stock volatile on the way up. Now that I've put the end of the video first, let me go with my case and my point and my praise first. My praise for the All-In podcast. You may know that there's no such thing as bad publicity. Actually, in the case of the All-In podcast, I thought that the critical mind who will listen to this podcast will find that the statements that were made were perfectly fine. And if anything, I find them bullish. I'll tell you why I find them bullish. First of all, I want to point out that the question was not framed properly. The question was about the MicroStrategy convertible debt, hence my response, which was a response about the convertible debt. But keep in mind that right now, most of the Bitcoin buys right now have been fueled by the ATM. We are not at the big convertible stage of MicroStrategy. Most of the 21 billion plan for the convertible debt is likely going to come in 25 or in 26. We are not at that stage yet. So either the All In podcast is very early in asking that question, or the wrong question was asked on this podcast. That's the point number one I want to make. But on the second point, which was the commentary of the guests, first of all, the first guest, again, someone I respect, called Michael Saylor eloquent. Said Michael Saylor, he began by saying that Michael Saylor makes an eloquent case for Bitcoin and for his strategy. That's the first point of the guest. Eloquent is the term that was used. And sure enough, I believe MicroStrategy makes an eloquent case. Eloquence, is a rare skill. And then he talks about the 75 million interest rate expense on the convertible notes. You can already know where I'm headed with this, because I just showed you volatility and I just showed you what can happen to the coupons. What happens if much of those notes are issued at negative coupons? He talks about how the business of MicroStrategy, 400 million of high margin revenue, that's great, but that can probably not cover much more than 75 million of interest expense. And so because of that interest expense, MicroStrategy can't really go too big on the convertible debt because they won't be able to pay the interest expense on those coupons, on the money that they're borrowed. Again, this makes a lot of sense. But I think the question was misguided. I think the question should have been on volatility. And lastly, he makes a statement on magic money creation machines discussed on X. Now, I know there's a lot of, as much as I love X, there's a lot of dumb things on X. I'm sure there's been some dumb statements made about MicroStrategy on X. X, the recommender system is so good. The statements that I see on MicroStrategy are excellent takes in general on X, but it depends on what you follow. And I don't doubt that what Saylor is doing is different than what a lot of people have described on X. X is a big place. I'm sure there are some people who are saying BS, kind of wrong things about MicroStrategy, but that's not what I'm recommended on X. What I'm recommended on X is striking analysis from people who really get it. But then again, each X recommendations are different depending on who you are. And the second guest started by saying that they were very bullish on Bitcoin. They said that they wanted to protect the retail investor, and then the second guest quickly moved on to another topic. So to me, the second guest fully qualifies as dodging the question. He said he wants to be careful for retail, which I totally agree. And he said he was very bullish on Bitcoin, which I totally agree. So yeah, I don't want people retail to lose money. I agree with that. So I agree with just about everything. I believe a first guest would have handled the question in a much better way if it had been asked differently, because the question that was asked was the wrong question. Don't forget, this is a form of journalism. If you ask the wrong questions, you're not going to get the answers that you need to get. This is the question that I would have asked. The question that I would have asked is I would have asked about the ATM, the at-the-market securities offering program. Because Saylor, and by the way, that was in the discussion of a treasury strategy that was announced last month. So this is part of a 21-21 plan. If you look at the 21-21 plan, talk is cheap. Actions are what matter. Sure, Saylor said it would do half and half, but when you look at the actions, he's way ahead on the ATM. He's 9.7 billion out of the 21 on the ATM. He's only 3 billion out of the 21 on the convertible bonds. So the actions that should have been commented on by the All In podcast should have been the ATM, because 81% of the Bitcoin buys have been done via the ATM. The convertible bond question is for now just 19% of the strategy. So again, I'm going to say the All-In podcast is early discussing this. I wish they would have commented on the ATM itself, which the ATM is what I call on this channel and in many prior videos, I've called it the simple black hole strategy. You get MicroStrategy added to the QQQ, money expands. When money expands, half of that money perhaps goes towards long-term capital. Equities, real estate, and bonds. These are the three buckets of long-term capital. So the money expand, the money makes it to the equities, and then the equities themselves stick to the indices. And Michael Saylor and MicroStrategy are in these indices, and they're able to do ATM because they get more and more bid from those indices, more and more people buying. So you're able to issue more stock via the ATM because a lot of the buyers of that stock are that natural stock. I could make a case that Apple would not be as high in the indices if it was not number one in the index. There's a feature of the index which makes it that you have a perpetual bid. So I could make that case. To me, this is the right now, the MicroStrategy right now, to me, the big story of MicroStrategy right now is the fact that they're going to be added to the indices and that they're able to do ATMs and that these ATMs are subscribed and they create some volatility in the stock, but nowhere near an ATM does on a stock. I follow stocks for well over a decade. On this channel, more than 2 years. I can tell you, when a struggling company does an ATM, typically the stock drops 30%. It's very rare to see a company do ATM after ATM after ATM and the stock price is volatile, sure, but if you take a long-term moving average, it's behaving beautifully and it's not dropping very much. So they're able to do the ATMs. This is the big story right now. But it seems like the lion's share that is getting discussed in All-In and everything is about the 19% of the other strategy, which is the convertible bond strategy. So let's talk about the convertible debt. Again, it's 19% of a strategy so far. I agree that it will presumably be a greater percentage of that strategy in 25 and 26. Assuming, of course, they don't announce another new ATM. Because that black hole strategy, that ATM, who knows? They could be done with their ATM in March of 25, and then you have that bid, and then they may get added to the S&P 500 or something because they're going to have to recognize so much money. And maybe they get added to other phones, and so they could do another ATM. If they run out of a 21 billion ATM, they could do another ATM, in which case it would skew the story even more towards the ATM. But let's assume they don't announce another ATM. At the end of the day, the 19% strategy so far on converts will be a 50% strategy. It will be 50% of a treasury strategy of MicroStrategy. So the treasury strategy of MicroStrategy, part 2, 19% so far, is to sell convertible debt to buy Bitcoin. Now, I want to make sure that we're not being too absolute. I covered this in an entire video. I estimate, based on my research, that about 75% of the buyers of a convertible debt do it for volatility arbitrage, for gamma trading, not delta, gamma. They don't care about the direction, they just do it for volatility and make money on the volatility. But I still estimate that about 25% of the people do it as an investment. And just look up iShares Convertible Bond ETF and look at 11 of their biggest bond and look at their biggest bond, right? The iShares Convertible Bond ETFs as for number one bond, the MicroStrategy convertible bond. There's bond funds out there that buy the convertible debt as part of the funds. And so it's to me, it's not 99%. People get very absolute. In my view, there's a good 25% that buy those bonds as an investment. Now, let's focus on what everybody seems to think is all they're doing, which is 75% of the 19%, which is volatility arbitrage and the convertible bonds. So let's talk about that. So 75% of these buyers, I say that they buy that just for the super long-term call option. They just buy it for the embedded call option. Why do I say that? Because the $3 billion offering has no coupons. They agree to borrow, to lend the money to MicroStrategy with no coupons. So clearly the coupons is not part of the money that these hedge funds are trying to make. These hedge funds are trying to make money on the gamma trading, and they're trying to make money by having access to that super long-term call option that is embedded within the convertible bond. So let's go. Let's talk about it. So what are the convertible bond buyers getting? I'm taking the last example of a $3 billion offering of a convertible senior notes due 2029. Okay, so they're getting the right to buy $3 billion worth of MicroStrategy stock in 5 years at the price of $672 per share, so significantly higher than today. Today is trading at $395, right? So that's what they're getting. And what's the cost on that? Well, the cost is giving up on interest rate on $3 billion for 5 years, assuming what I think would be a more risk-free type of rate. Assuming a risk-free type of rate, I'm going to assume 6%. What are they giving up? They're giving up a 6% coupon on $3 billion for 5 years, so a total of 30% of $3 billion, $900 million. You feel free to put whatever number you want. I assume they are giving up $900 million. To me, this is what borrowing this money would have cost a normal company. A normal company borrowing this money would have paid $900 million. Now, you could argue a company, a smaller company, or you could argue a company borrowing this money could have paid 11%. Right? You could argue they could have paid more. You could argue, like if you were to argue, for example, that Bitcoin is totally risk-free, which is absolutely not what I'm saying, but if you were to argue that, you could say, oh, well, really they're paying the equivalent of 11%. Now, that 55% conversion premium, some of that is, of course, the binary risk of not MicroStrategy, but Bitcoin failing. Some of that is that counterparty risk, of course, but you know, it's somewhere around there. The premium collected by MicroStrategy on issuing that $3 billion debt, the savings generated is about 900 or a billion or 1.1 billion. Let's call it 900 million is what I'm calling it. So they're effectively using these convertible bonds to write a very long-term call option themselves on their own stocks, and they collect the premium themselves via way of saving $900 million. When you borrow at 0%, you collect the premium yourself in the form of interest that you don't have to pay. And you build your own return. You create your own return by buying Bitcoin at today's price with that premium, with that borrowed money. The money you make on borrowed money, you could call it leverage premium, or you're making a leverage gain, but you're also making a premium gain in the form of interest that you don't have to pay. And of course, the bond is getting repaid in the future via dilution. The difference between the growth in Bitcoin and the growth in dilution, that difference is what Michael Saylor calls the yield, calls the Bitcoin yield. So let me move on. What's in it for the convertible bond buyers? Well, what's in it is gamma trading. This is Grok. Feel free to read how they do it. This is not an options channel, but feel free to read this. This is Grok explaining how they do it. And you can ask any AI, you say, explain like I'm 5, and they explain to you how you earn money on volatility. This is not the point of the video. The point of the video is that hedge funds earn a profit on the volatility regardless of the direction of the stock. They could care less about the direction of the stock. They care about gamma. They care about earning profit on the volatility. What they do is they buy the long-term call option in the form of a convertible debt, and they short the stock, and they adjust how much stock is being shorted every time there's a big change in the price in order to remain delta neutral over time. And so over time, you earn a percentage of yield on the volatility of MicroStrategy, but you try to be delta neutral most of the time, i.e. you adjust your short position to make sure that you're not exposed to the stock price movement, but that you're only exposed to the volatility. You make money on volatility. And in this context, in the context of convertible bond buyers who want to make money on volatility, these buyers will pay more for a stock that is more volatile. So a convertible bond written on a stock that goes up and that goes up, down, up, down, up, down, up, down, up, down, that goes up with volatility, you're going to have a higher premium. MicroStrategy is going to be able to collect a higher premium on a stock that is highly volatile. So those 900 million that they save in interest, it could be higher if the stock gets more volatile. Now, when the stock is less volatile, MicroStrategy collects less premium. Going back to my example when I started the video, if you sell a low octane gas for the car, you're going to collect less premium because your car is not going to run as fast. But if you sell a high octane gas for your car, you're going to collect a high premium. So hopefully that makes sense. And what is Saylor doing? Saylor wants the stock to remain volatile, because if Saylor keeps up the volatility in the stock, Saylor can keep selling convertible bonds at a higher and higher premium. And how does Saylor do it? How is Saylor able to make the stock much more volatile? Well, how does MicroStrategy stock become more volatile? Well, first of all, you become more volatile by becoming more and more Bitcoin based. You keep adding Bitcoin on the balance sheet. And so the company started out as half a software company, well, 100% software company, and then it quickly became half a software company, half a Bitcoin company, and now the software company is like 1/30 of the company. So the more Bitcoin you have on the balance sheet, the more your asset, the more MicroStrategy's asset is going to take the form of Bitcoin's volatility. That's point number one. Then you enhance the volatility on Bitcoin by leveraging, by having some leverage. Because you have some borrowed Bitcoin, your volatility with leverage is going to be higher on the stock than on pure Bitcoin. And then, this was my point in my last video, you excite the stock. You excite the stock by strategically deploying your ATM when the stock peaks. You make sure that it doesn't end up being a smooth ride. If Bitcoin keeps going up, the last thing MicroStrategy wants to do is for the stock to keep going up at a highly correlated rate. Because if Bitcoin goes to the moon and MicroStrategy goes to the moon in the same pattern, then you're decreasing the volatility. So MicroStrategy, in my view, is issuing at the market offering. They're issuing new shares whenever the price to NAV peaks. Whenever MicroStrategy's price gets up too high, or whenever the volatility seems to be running away, boom, you can issue new shares. And when you issue new shares, you tune the stock down. You make the stock go down 10% or 15%. And you keep that volatility alive. And also, you can trust, because you're going to be MicroStrategy, because you're going to be such a prominent person in Bitcoin, you're going to have the media card, and you can trust that the media is going to keep hating on your stock. And we've seen this over and over in many of the mainstream news channels. Because why would the media prefer hating on MicroStrategy? Because if it bleeds, it leads. The media is the same story. You may remember when Bitcoin broke 100,000, the headline on CNBC, the main headline, the main story on CNBC.com was not rejoice, Bitcoin is at 100,000. Nobody wants to click on that. No, the main headline was MicroStrategy stock down, Saylor's big bet. And so whenever the media does it really helps with the volatility. That's great for volatility. When people go ahead and call out your stock and say bad things about your stock, that's great for volatility. Whenever you show up in the news, that's great for volatility. So there is a Saylor volatility effect, a Saylor premium effect on top of that. So in my view, all of this contributes to the volatility. And you could have the short sellers. Whenever you have a new short seller who says, oh, I want to take a trade against MicroStrategy, and they become public, that adds to the volatility. It's not just the ATM. Saylor has multiple tools in the toolkit to keep the stock going up and down and up and down and up and down. And of course, the elephant in the room, what I think MicroStrategy is doing, is making sure that the stock remains volatile. And what happens to the convertible debt if and when and as MicroStrategy becomes more and more volatile? Well, that's what I call the elephant in the room here, which is if the stock becomes more volatile, if the volatility just continues, but hopefully it becomes a little more volatile, what's going to happen? Well, you can sell even more convertible debt at an even lower conversion premium, or, and this is what I think Saylor is going to do, option B, you can sell your convertible debt perhaps with the same conversion premium, but at an even lower coupon. And an even lower, the coupon right now on the $3 billion is 0%. What's an even lower coupon? An even lower coupon is lower than 0%, negative interest rates. So what if Saylor is able to sell convertible debt at negative 0.5%? Well, then all of a sudden, the conversation laid out by All In and laid out by having to pay the $75 million of interest on already issued convertible notes, all of a sudden that discussion ends because the negative interest rates, the negative interest rate can cover those coupons that you issued years back. This is so genius. I don't even know what to say. I love this strategy so much. This is no financial advice, as you know, in this channel. So let me conclude and go back full circle. Volatility is vitality. Just like a refinery would like to sell to everybody 91 octane gas, 100 octane gas. A refinery would love to do that. Chevron would love to do that. They sell 87 gas. That's already good, but they want to increase the volatility. And so why do you want to have a more volatile gas? Why do you want to have a higher octane gas? Because it makes your engine go faster. And you're the car owner, and maybe you want your engine to run a little faster. And if you want your engine to run a little faster, you're going to pay up that premium. You're going to pay up that premium to get the 100 octane. Well, the same happens for hedge funds. Hedge funds, maybe they want to make a little more money. Maybe hedge funds are greedy even. Maybe they want to make even more money. And so if you want to make even more money, wouldn't it make sense for you to buy the convertible debt on the super high octane stock, on the super highly volatile stock? So this is why they're all rushing to buy MicroStrategy, because MicroStrategy is hyper volatile, right? The premium will be much higher on a volatile convertible debt. And who's collecting the premium when a company sells convertible debt? When a company issues convertible debt, that benefit, that premium flows to the company. It flows to the company. And so that's what MicroStrategy is doing. And that's what I wish they had talked about on the online podcast. But of course, that question was not asked. And I have no doubt that if that question was asked, we would have had very interesting insights. Unfortunately, the question that was asked, in my view, was not the right question. But I agree with All In, and to me, this is an amazing story. So, anyways, this was not investment advice, not financial advice. This is just entertainment. Please like, please subscribe. Thank you so much for watching, and have a wonderful day.